Welcome to the Trendline Gala podcast.
It's great to be here.
Today we are going to look at something that I think a lot of us just take for granted. We spend so much time obsessing over what we're going to buy.
Right. Which stock, which bond?
Exactly. Is the market going up or down?
Yeah.
But we rarely stop to think about the thing we're using to actually make those decisions.
We really don't. We focus on the destination, but we completely ignore the vehicle we're driving to get there.
That's a perfect way to put it. I'm talking about the app on your phone or the platform on your desktop, the specific interface you use to interact with your money. And the core idea we're exploring today is, well, it's a bit unsettling.
It is.
We think we're in total control of our financial decisions, but the tools we use, they might be quietly pulling the strings.
It's a classic blind spot, a huge one. When you look at a chart or you see that big green buy button, you feel like you're the one in charge.
Of course, I'm the one clicking it.
You're the agent of change, the decision maker. But what we often miss is how the design of that whole environment is shaping the decision itself long before you ever click.
Okay, so let's break this down. Most people, and I'll include myself here, usually view a trading app like a tool in a toolbox, like a hammer or a wrench. It's just an object, right? It's neutral. If I hit my thumb with a hammer, that's my fault, not the hammer's.
That is the common perception, yeah. But here's where it gets really interesting. If we look at the architecture of disciplined trading, we have to correct that view and correct it immediately. Tools are not neutral.
Not neutral. That seems hard to wrap my head around. I mean, a piece of software doesn't have an opinion, does it?
It doesn't have an opinion, no, but it has an intent, and an intent built right into its design. Think about the hammer again. A hammer is designed with a specific purpose. It's heavy on one end, it has a handle on the other. It basically screams, hit something. It encourages you to go looking for nails.
Right. It has a function.
Exactly. Now apply that same idea to software. The design of a trading tool, the colors they use, the placement of the buttons, the speed of the updates, it all actively shapes your behavior. It's engineered to influence how a person acts, especially when they're under pressure.
So you're saying it's not just a window into the market, it's actually nudging me.
It's so much more than a window. It's an entire environment. It's an ecosystem that you step inside of every time you log in. And the mission for our discussion today is to explain exactly how that environment affects your discipline.
Okay.
We really need to look at why boring tools are often safer and, how you can learn to spot the features that might actually be working against your own best interests.
I love that. The idea that boring might be a superpower. Okay, so before we get into the psychology of, buttons and colors, let's clear up some vocabulary.
Good idea.
Because I feel like I use terms like broker and app totally interchangeably, and I have a feeling you're going to tell me that's wrong.
You aren't alone in that at all. Most people use them as synonyms. But there is a distinction. It's really important if we want to understand the risks involved.
Okay.
Based on the framework from the architecture of disciplined trading, we need to separate three different things: the broker, the app, and the platform.
All right, let's walk through this. First one, the broker. What is that?
Think of the broker as the plumbing, the deep infrastructure. The broker is the actual service that places the trades and holds your account.
Okay.
When you buy a share of stock, the broker is the entity that's connecting you to the market exchange. Yeah. They're the ones dealing with all the regulations, the custody of your cash, and the clearing of the transaction.
Got it. So they are the pipes in the walls. They're making sure the water flows where it's supposed to go.
Exactly. They are the core infrastructure. Then you have the trading app.
The app.
The app is the interface, usually the thing on your phone, that you use to view prices and place your trades. This is the window.
The window. Okay, so the app is just the piece of glass I'm looking through to see what the plumbing is doing.
Precisely. And then finally you have the trading platform.
Platform.
Think of the platform as the whole toolbox. It's the comprehensive suite. It includes the charts, the analysis tools, the alerts, the news feeds, and all the execution features.
I see. And often these three things, broker, app, and platform, are all packaged together by one company, which is probably why we all get confused.
That's exactly why. But functionally, they are very distinct.
So why does a listener need to know the difference? I mean, why not just call it my money app and be done with it?
Because understanding the difference helps you separate function from temptation.
Function from temptation. I like that.
The broker's function is just to execute the trade. That's utility. It's necessary. The app's function is to show you the price. But the platform's design, the way it shows you that price, the way it highlights certain movements with colors and alerts, that's where the psychology kicks in.
So it's about knowing which part of the system is just the utility and which part is, well, the marketing.
That is a great way to put it.
Yeah.
And there's a practical safety element here, too.
Oh,
If your app freezes up on a busy day, does that mean your broker is down?
I would assume so, yeah.
Not necessarily. The window might be painted over, but the plumbing is probably still working just fine. Knowing the difference means you can probably still call the broker on the phone or log in through a website to close a trade if the app itself crashes.
That is actually a huge relief to know. But let's get back to the risk.
Right. We have to remember the context here.
Mm-hmm.
The market is simply a place where buyers and sellers meet to decide on prices.
Okay.
Usually you need a broker to help you do that. But unlike a bank, where your deposits are insured.
Right, if I put money in a savings account, it's generally safe. Even if the bank has a bad day, my money's still there.
Correct.
Eh.
But securities, they fluctuate. No one guarantees you will make money. You can lose value. The underlying asset itself is volatile by nature.
So because the underlying asset, the stock or the bond or whatever, is already risky.
Exactly. Because there is real risk involved, the interface you use to manage that risk shouldn't add more danger through bad design.
It shouldn't make a risky thing even riskier.
It shouldn't. If the road is icy, you don't want a car that has twitchy steering or brakes that rely on some confusing touchscreen menu. You want mechanical stability. You want something predictable.
That is a great analogy. And if the market is an icy road, a lot of modern apps feel like they are built to go 100 miles an hour. They feel like sports cars when maybe we should be driving tanks.
And that leads us directly into the psychology of all that speed and flash.
Let's look closer at this part. I open some of these modern apps and it feels like I'm in a video game. There are flashy lights, big green and red buttons. Sometimes confetti literally falls across the screen.
Oh yeah, the confetti.
It's exciting. I have to admit, it feels good to use them.
Of course it does. It is designed to feel good. It's designed to be exciting. But here's what we know. Fast tools encourage fast decisions.
Yeah, is that always a bad thing? I mean, speed sounds like an advantage.
In high-frequency algorithmic trading done by supercomputers, yes, it's an advantage. For a human being trying to build wealth over time, it's almost always bad.
Okay.
The architecture of disciplined trading argues that good trading behavior depends on slowing down. You need time to analyze, to verify, to check your plan. But modern design often pushes users to speed up.
It's that swipe to buy culture. Make it frictionless.
It is. The buttons, the alerts, the flashing charts, they all affect how quickly someone acts. When an app is designed with what we call high urgency cues, bright flashing colors, ticking clocks, countdown timers, it triggers a physiological response in you. It prepares you to react.
So you stop thinking and start just reacting. It kind of bypasses the logic center of your brain.
You shift from the analytical part of your brain, the prefrontal cortex, to the much more reactive part, the amygdala. And busy tools, they encourage constant attention. They want you looking at the screen all the time.
But isn't that what they sell us? I see ads constantly that say things like, now with more features, more alerts, real-time everything. It always sounds like more is better. If I have more data than the next guy, don't I have an edge?
In consumer electronics, maybe. But in the context of financial discipline, more is often worse.
How can having more information possibly be worse? That feels completely counterintuitive.
It all comes down to something called cognitive load.
Cognitive load. Explain that for us.
Every single feature you add to a screen demands a tiny little bit of your brain power just to process it.
Okay.
If you have a chart, that's one thing. If you then add a scrolling news ticker, that's another. Now add a flashing price alert. Then add a social sentiment meter. Then add a leaderboard of the top traders for the day.
My brain is getting tired just listening to that list.
Exactly. More features equals more alerts, which equals more buttons. And this results in a very high cognitive load. The architecture of disciplined trading points out that each extra feature just increases the chance for you to break your own rules.
Because I'm distracting.
Because you are overwhelmed.
Yeah.
When the brain is overwhelmed, it looks for the path of least resistance. It wants a shortcut. And often, that path is an impulsive decision, just to relieve the tension of trying to process all that data.
Yeah.
It makes it significantly harder to stick to your long-term plan.
I have definitely felt that. You open an app just to check one simple thing, and suddenly you see 3 other things flashing and you go down a rabbit hole. And then 10 minutes later, you've bought something you didn't even intend to.
That is the trap. And we have to talk about notifications because they are the gateway to that trap.
Oh, the constant pinging on the phone. This stock is up 2%. This crypto is down 1%. It never, ever stops.
Those notifications are not neutral information. They are attention hooks. They are designed to pull you in. And frequent notifications pull your attention specifically to short-term movement.
It makes everything feel so urgent, like a little fire alarm going off in your pocket.
And that shifts you, the user, from following a plan to just reacting to noise. I mean, think about it. If your plan is to hold a mutual fund for 20 years for your retirement, do you really need to know that it dropped 0.5% this morning at 10:30 a.m.?
Probably not. In fact, knowing that might just make me panic and sell it.
Exactly. But if your phone buzzes, you look. And once you look, you start thinking. And once you start thinking under pressure, you might act. Tools that are constantly demanding your attention make discipline so much harder.
It's like trying to be on a diet, but your refrigerator texts you every single time there's a slice of cake inside.
That is a perfect way to put it. And just like with a diet, the environment matters more than almost anything. If you want to be healthy, you don't fill your house with junk food. If you want to be a disciplined investor, you shouldn't use a tool that is constantly trying to get you to snack on trades.
That makes so much sense. We have to control our own environment. Speaking of control,
Yes?
this episode is sponsored by TrendlineGala.com. Quiz your way to financial mastery.
A very relevant sponsor for today's topic.
Absolutely. Okay, moving on from that. We've talked about the flashy, the noisy side of things. Let's flip the coin. What happens when these high-speed, complex tools fail? Because I've seen people absolutely freak out on social media when an app crashes on a really busy day.
And they should. That is the hidden cost of all that complexity.
Right.
Reliability matters so much more than excitement.
Because if I can't log in.
If you can't log in, or if the charts are lagging behind, or if the buy button freezes right after you click it, you experience a massive, massive spike in stress.
It's panic, really.
It is panic. And when the tool behaves unexpectedly, it breaks down completely. You aren't following your plan anymore. You are just trying to survive the tech failure.
So, reliability is boring, but it works.
Reliability works consistently and predictably. And that consistency is what keeps your heart rate down. Unreliable tools cause discipline to break down because they introduce a new layer of uncertainty into a process that is already completely uncertain.
So clarity and stability are actually more valuable than speed.
Always. Every single time.
Yeah.
You cannot execute a disciplined strategy if the ground is shaking beneath your feet.
This brings us to a concept that I think is going to sound really counterintuitive to a lot of our listeners.
I think so too.
We live in a world that just worships the new, the fast, the shiny. But you are suggesting we should actively look for boring tools.
I am. I am making the case for boring.
Sell me on boring. Why would I want that?
Because boring tools reduce that feeling of urgency. They're quiet. They don't flash at you. They don't have a little celebration animation when you deposit money. They limit distraction.
They just
sit there.
They just sit there. And because they aren't screaming for your attention all the time, they create space for you to think.
Space to think. That really does feel like a luxury these days.
It is an absolute necessity for financial security. And if you look at the resources that are provided by the government and the main regulatory bodies, they are the definition of boring, and they are incredibly powerful.
Okay, let's look at some examples then. What does a good boring tool actually look like? I'm guessing it doesn't have a cute mascot or a rewards program.
It definitely does not have a mascot. If we look at websites like investor.gov and finra.org, we find tools that are purely beautifully functional.
Like what?
Well, take the calculators on investor.gov. They have a savings goal calculator, a compound interest calculator, a required minimum distribution calculator for retirees.
Okay, those sound like math homework from high school.
They are math homework. But think about the behavior they encourage. You have to sit down. You have to input your numbers thoughtfully. You look at a projection for 10 or 20 or 30 years into the future. It forces you to look at the long term.
Exactly. It forces a long-term perspective. And that is the complete opposite of a ticking price chart, which forces a 5-second perspective on you.
That's a huge, huge difference in mindset.
And Finera has a fund analyzer. It allows you to really analyze the fees and the hidden costs of mutual funds and ETFs. They have a bond watch list.
These sound like tools for planning, not for gambling.
Correct. And then there's the roadmap to saving and investing on investor.gov. These tools don't flash, they don't ping you, they just help you calculate, plan, and verify.
So the analysis here is that the lack of flash is actually a feature, not a bug.
The lack of flash is a safety feature. It encourages you to look at the long term, your retirement, your 401k, your IRA, rather than the tick-by-tick price of some volatile asset.
It sounds like boring helps you remember why you are investing in the first place. To build a nest egg, to send your kids to college, not just to get a quick dopamine hit from seeing a green arrow go up.
Precisely. And this leads us to what you could call the hierarchy of decision-making.
The hierarchy.
We need to ask a really fundamental question. Can a really good tool make you a good trader?
I feel like the answer has to be no, but I really want it to be yes.
The answer is a firm, unequivocal no. No tool can replace your own judgment or your own rules. You cannot download discipline from the App Store.
I wish I could. App Store, search for discipline.
It would be a bestseller. But here's the reality. Tools should support your rules, not replace them.
Okay, so what is the role of the tool then in a healthy system?
A good tool makes it easier for you to pause before acting. That is its primary job in a disciplined system.
To put a speed bump in the road.
In a way, yes. Good tools help you review your decisions. They might have a confirmation screen that makes you re-enter the order details. They help you check if a trade fits within your existing limits. Bad tools encourage action without reflection.
So it's the difference between a tool that asks, are you absolutely sure you want to do this? And a tool that just says, do it now.
Exactly. And we have to understand the regulatory backdrop here as well. We mentioned the SEC and FINRA earlier.
Right, the watchdogs.
Here's what we know. The SEC enforces the laws on how investments are sold to the public. They are there to protect investors and maintain fair, orderly markets. That is their core mission.
And FINRA?
FINRA is a self-regulatory organization that provides tools to check up on brokers, like BrokerCheck, and to protect against fraud.
So they are the safety net.
They are a safety net, yes. But they're a safety net against fraud and systemic unfairness. But, and this is the crucial part, they cannot protect you from your own impulsive decisions made on a flashy, gamified app.
I see the distinction. They can stop a broker from stealing my money, but they can't stop me from losing my money because I got excited and clicked a button I shouldn't have.
You've got it. The regulations ensure the game is fair, but they don't ensure that you play it wisely. And that is why choosing the right tool, the right interface, is a deeply personal responsibility.
So it's really on us to curate our own digital environment for our finances.
It is. And a tool that slows you down, a tool that encourages a pause, can protect your money far better than a tool that promises you more speed.
That's a powerful takeaway. You know that old saying, slow is smooth and smooth is fast, or at least in this case, smooth is safe.
In investing, slow is usually profitable.
So let's bring this all together. We've covered a lot of ground today looking at the architecture of these platforms. If we were to summarize the whole architecture, it really seems to come down to a few core truths. First, tools shape our behavior. They are not neutral.
Right. We have to stop treating them like inanimate objects. They are active participants in our psychology, whether we like it or not.
And second, fast and busy equals temptation and reaction. If your screen looks and feels like a casino, you're probably going to start trading like a gambler.
And conversely, boring and stable equals thought and discipline.
So what does this all mean for the listener who's sitting here right now, maybe with their phone in their hand?
It means you need to audit your tools.
An audit. How do you do that?
It's simple. Open your trading app or log into your platform. And just ask yourself one simple question. How does this make me feel?
That's a good question.
Does it make you feel anxious? Is there a constant sense of urgency? Do you feel like you need to do something right now or you'll miss out? Or does it make you feel calm? Does it make you feel prepared and in control?
If it makes you feel like you're missing out, that FOMO feeling, it's probably playing against you.
That's it. Excitement is not an advantage when control matters. You want to feel like a pilot in a cockpit, calm and methodical, not like a contestant on a game show hitting a buzzer.
I love that image. Be the pilot, not the contestant.
Exactly.
Well, this has been a real eye-opener. I'm definitely going to be looking at my own apps a little differently after this conversation.
It's always worth a second look.
If you're a beginner and want to learn more about trading, you can take our free beginner trading quizzes at trendlinegala.com.
It's a great place to start testing your knowledge without risking a single dime.
Next time, we'll talk about how to decide whether trading even fits your life and goals in the first place.
And that is probably the most important question of all.
Thanks for joining us at Trendline Gala.